In 1929, stocks crashed 89%, but bonds held their value. In 2008, real estate collapsed 55%, but treasury bonds rallied 43%. Every major crash in history had a safe haven. Somewhere to hide. In 2026, there is no safe haven. This isn't doom-scrolling content. This isn't conspiracy theory. This is what happens when 14 years of zero interest rates and $16 trillion of money printing inflate every asset class simultaneously. This is the mathematics of interconnected bubbles. When everything is overvalued at once, everything corrects at once. Let me show you why the numbers say what no one wants to hear. 3 alarms are sounding right now. Most people can't hear them. The first alarm: stock market valuations have reached a Shiller-Cape ratio of 39, higher than the 1929 peak, higher than every point except the dot-com bubble of 1999. The market isn't just expensive. It's priced for perfection in a world that delivers anything but. The second alarm: commercial real estate buildings worth $180 billion in 2021 are now worth $90 billion. But banks still carry them on their books at $145 billion. The losses exist. They just haven't been recognized yet. They're sitting in balance sheets like unexploded ordnance, waiting for someone to finally admit the truth. The third alarm: $13.7 trillion in corporate debt must be refinanced in the next 24 months at interest rates triple what companies originally borrowed. Not slightly higher. Triple. Companies that borrowed at 3% must now refinance at 9%. That doesn't just hurt profitability. It guarantees a wave of defaults that will dwarf 2008. Here's the number that should stop you cold: $35 trillion. That's the projected wealth destruction in the United States alone. Not globally. Just America. When you adjust for inflation that exceeds the 1929 crash and the 2008 crash combined. Robert Chen still remembers the exact moment he realized something was wrong. He was 57 years old, sitting in his home office in suburban Chicago, reviewing his retirement accounts on a Tuesday evening. His wife was making dinner. The house was quiet. Robert had $1.2 million saved, 60% in stocks, 30% in bonds, 10% in cash. He'd done everything the financial advisors told him to do. Diversified, stayed the course, trusted the system. But as he ran the numbers on his screen, calculating what would happen if stocks fell even 40% while bonds fell 20%, his hands started shaking. He'd be 62 when he could access the money without penalty. If the projections were right, he'd have $480,000 left. Not enough to retire, not enough to recover. Robert isn't a pessimist. He's a mechanical engineer who spent 35 years building things that work. And the math doesn't work. What most people get fundamentally wrong about this moment is believing diversification will protect them. In every previous crash it did. Stocks crashed, bonds rallied. Real estate fell, gold rose. Some asset class always provided refuge. The 2008 playbook said stay diversified, ride it out, recover in 5 years. But that playbook assumed assets moved independently. It assumed when one thing crashed, something else held value. It assumed there was always somewhere to hide. In 2026, every asset class is simultaneously overvalued by 40 to 150%. Stocks at historic extremes. Bonds inflated by 14 years of Fed buying. Real estate up 47% from pre-COVID levels. Private equity at record valuations. Cryptocurrency speculation. When everything is in a bubble, simultaneously diversification doesn't protect you. It just means you lose money in multiple places at once. One-liner worth remembering. Diversification is a seatbelt. It doesn't help when every car on the highway crashes at the same time. Here's the first question that should disturb you. If you were designing a financial system specifically to create the largest possible crash, what would you do differently than what we've done for the past 14 years? The answer is uncomfortable. You probably wouldn't change much. Jennifer Martinez still remembers the exact moment she understood she was trapped. She was 34 years old, standing in the kitchen of the house she and her husband had bought in Austin in November 2021. They'd paid $480,000, with 5% down, $24,000 they'd scraped together over 4 years. The house was supposed to be their foundation, their equity, their security. But sitting at that kitchen counter with her laptop open, she watched the Zillow estimate tick down for the third month in a row. $451,000. Then $427,000. Then $398,000. She did the math in her head. They owed $456,000. The house was worth less than the debt. They were underwater, and her husband had just heard rumors about layoffs at his company. Jennifer's situation isn't unusual. It's the mathematical consequence of people buying at peak prices with minimal down payments, then watching rates triple from 2.7% to 6.8%. The affordability calculation that made $480,000 seem reasonable at 2.7% makes the same house impossible to sell at 6.8%. Visualize two charts side by side. The first shows home prices from 2020 to 2025, a 47% vertical spike. The second shows mortgage rates over the same period, a near vertical climb from historic lows to levels not seen in 20 years. These lines cannot coexist forever. Something breaks. Now let me show you the contrast that explains who survives this. Michael Torres is 52 years old, owns a plumbing business in Phoenix, and has zero debt. No loans on his trucks, no credit line with the bank, no expansion funded by borrowed money. When other plumbers ask why he operates so conservatively, he tells them about 2008. He lost his previous business in that crash, overextended, dependent on credit that vanished overnight. He rebuilt from nothing, and he swore he'd never be vulnerable again. When the credit freeze hits in mid-2026, and it will hit, Michael's competitors will face the same choice he faced in 2008, banks freezing credit lines, payroll coming due. No way to bridge the gap. They'll close. Michael won't. He'll buy their customer lists at 10 cents on the dollar. He'll hire their best workers at market rates because they need jobs. He'll emerge from the crash stronger than he entered. Same industry. Same crash. Opposite outcomes. The difference isn't luck, it's structure. Here's the second question that should keep you up tonight. If the crash has already begun, commercial real estate down 35%, regional banks down 40% since 2021. Why doesn't anyone seem to notice? Because crashes don't announce themselves. They accumulate in corners people don't watch. They build in slow motion until they suddenly accelerate. The subprime mortgage crisis was visible in 2006 to anyone examining the data. The dot-com bubble showed cracks throughout 1999. The signs were there. Most people didn't look. One more one-liner. The crash has already started. You're just not watching the parts that are crashing. Marcus Webb still remembers the exact moment his world changed in 2008. He was 43, a middle manager at a manufacturing company in Ohio, watching the television in the break room when Lehman Brothers collapsed. Within 6 months, his company had filed for bankruptcy. His 401k lost 62%. His company stock, 20% of his retirement savings, went to zero. He spent the next 4 years rebuilding, finally recovering his net worth by 2014. Marcus is 59 now. He's rebuilt to $890,000 in retirement savings. And he sees the same patterns he saw in 2007. The same denial. The same assumption that this time is different. The same inability to imagine that what happened before could happen again. But this time, he doesn't have 15 years to recover. This time, nobody does. The timeline analysts are projecting shows the acceleration hitting between Q2 and Q4 of 2026, a 6-month window where the cascade moves from controlled decline to systemic panic. But to understand why that timeline is different from a guess, you need to see the 7 bubbles that exist simultaneously and the mechanism that connects them like dominoes. Because this isn't just an overvalued stock market. This isn't just commercial real estate losses waiting to detonate. This isn't just corporate debt that can't be refinanced. It's all of them, at once, connected. And when the first domino falls, the mathematics of interconnection determine what follows. To understand why 2026 is different, you need to understand how we got here. Not as a list of events, but as a mechanism. A machine that was built over 14 years piece by piece, that now operates with its own logic. The machine has a simple design: make borrowing cheap, inflate asset prices, create the illusion of wealth. The machine worked beautifully for 14 years. The problem is, machines built on artificial conditions eventually meet reality, and reality doesn't negotiate. Let me show you how the machine was built. September 2008. The financial system is collapsing. Lehman Brothers has just failed. Credit markets are frozen. Banks won't lend to each other. The Federal Reserve, facing the worst crisis since the Great Depression, makes a decision that will shape everything that follows: cut interest rates to zero and begin printing money to buy bonds. This wasn't controversial at the time. It was emergency medicine. The patient was dying. You use whatever tools you have. The Fed's balance sheet, the total assets it holds, was $900 billion before the crisis. By 2014, it had grown to $4.5 trillion. The Fed had printed $3.6 trillion and used it to buy treasury bonds and mortgage-backed securities, pushing down interest rates and flooding the system with cash. Think of it like this. Imagine you're a landlord and someone starts paying half your tenant's rent with printed money. What happens to rents? They go up because tenants can afford to pay more. What happens to property values? They go up because the income stream is higher. Everyone who owns property gets richer. Everyone who doesn't falls further behind. That's what quantitative easing did to asset prices. Every stock, every bond, every piece of real estate rose in value. Not because the underlying businesses improved, but because money was cheaper and more abundant. Patricia Nguyen still remembers the exact moment she understood the new rules. She was 41 years old in 2012, a commercial real estate broker in Los Angeles, watching a bidding war unfold on a mid-rise office building downtown. The building was generating $2.1 million in annual rent. In normal markets, it would sell for roughly $25 million, about 12 times earnings. But with interest rates at zero and money flooding the market, investors were bidding $42 million. Nearly 20 times earnings. The math didn't make sense by traditional standards, but traditional standards had been suspended. Patricia adjusted. She stopped questioning valuations and started facilitating them. Her commissions doubled, then tripled. She bought a bigger house, upgraded her car, enrolled her kids in private school. She wasn't greedy, she was rational. The rules had changed, and she played by the new rules. The problem: the new rules weren't sustainable. They were emergency measures that became permanent policy. What most people get fundamentally wrong about the past 14 years is thinking the Fed's intervention was temporary. It wasn't. Zero interest rates lasted from 2008 to 2015, 7 years. Then a brief attempt to normalize rates, followed by cuts back to zero in 2020. Then more printing, another $4.8 trillion during COVID, pushing the Fed's balance sheet to $9 trillion peak. Visualize a chart showing the Fed's balance sheet from 2000 to 2025. From 2000 to 2008, it's a flat line at roughly $800 billion. Then a vertical spike to $2.5 trillion. Then a plateau. Then another spike to $4.5 trillion. Then another plateau. Then a vertical rocket to $9 trillion. 14 years of escalating intervention that turned emergency medicine into life support the economy couldn't survive without. First direct question. If an economy needs $16 trillion in printed money and 14 years of zero interest rates just to function, is it actually healthy, or is it addicted to intervention? Here's the micro hook, the mechanism that explains why this time is different from every previous bubble. In 2008, passive index funds held approximately $1.2 trillion in assets. Today, they hold over $11 trillion. That's a 9x increase in a financial structure that didn't meaningfully exist before 2000. Why does this matter? Because passive funds don't make decisions. They follow rules. When money flows in, they buy. When money flows out, they sell, not based on value, not based on analysis, based purely on flows. In 2008, when the market fell, active managers could decide to hold. They could say, "These stocks are cheap, I'll wait." Passive funds can't do that. When investors redeem, passive funds must sell mechanically, automatically, regardless of price. Thomas Brennan spent 28 years as an active fund manager in Boston before retiring in 2021. He still remembers the exact moment he understood the game had changed. He was sitting in a quarterly review meeting in 2019, watching data on fund flows. Active managers were bleeding assets. Passive funds were vacuuming them up. The reason was simple: passive funds charged lower fees and matched market returns. Why pay a manager when you could own the index for nearly free? Thomas had no argument against the logic. He couldn't beat the index consistently. Almost no one could. But sitting in that meeting, he felt a chill. What happens, he asked his colleagues, when passive becomes so large that flows determine prices rather than fundamentals? Nobody had a good answer. The meeting moved on. What Thomas identified is called fragility. A system is fragile when small shocks create large consequences. Passive investing creates fragility because $11 trillion moves based on aggregate flows, not individual decisions. When redemptions begin, selling begets selling. There's no buyer of last resort except the Fed, and the Fed cannot buy stocks. One liner worth remembering. In 2008, humans decided to sell. In 2026, algorithms will execute selling without human intervention. Now let me show you the second mechanism, the debt spiral. Total U.S. debt, government, corporate, and household combined, stood at 190% of GDP in 1929. It was 350% in 2008. Today, it exceeds 400%. Think about what debt means at the household level. If you earn $100,000 per year and owe $350,000, you have options. You can pay it down over time, refinance when rates drop, or increase income to grow out of it. But if you earn $100,000 and owe $400,000, your options narrow. Every interest rate increase hits harder. Every income decline hurts more. You're walking a tightrope where any wind can blow you off. Now scale that to an entire economy. Remember Robert Chen from Part 1, the 57-year-old engineer with $1.2 million in retirement savings. His company, where he's worked for 32 years, has $2.8 billion in corporate debt that was issued in 2019 at 3.4% interest. That debt comes due in 2026. To refinance at current rates, roughly 8.5% for their credit rating, would add $143 million to annual interest expenses. That's $143 million that won't go to salaries, R&D, or dividends. The company will cut costs. Robert doesn't know it yet, but his division is being evaluated for restructuring. Here's the unexpected twist: the corporate debt problem is worse than it looks because of how it was used. In a healthy economy, companies borrow to build factories, develop products, or expand operations. The debt funds productive investment that generates returns. But over the past decade, cheap debt was used primarily for stock buybacks. Companies borrowed billions at low rates, bought back their own shares, boosted earnings per share without actually earning more, and paid executives based on those inflated metrics. The S&P 500 companies spent $6.3 trillion on buybacks between 2010 and 2023. They didn't build $6.3 trillion in new capacity. They didn't develop $6.3 trillion in new products. They financially engineered their stock prices higher while loading their balance sheets with debt. Second direct question. If companies borrowed trillions to inflate their stock prices rather than build productive capacity, what happens when they must refinance that debt at triple the original rates? The answer is, they cut. They fire workers. They cancel projects. They default. And when enough companies do this simultaneously, the economy contracts. Carla Simmons is 44 years old, a marketing director at a mid-sized consumer goods company in Minnesota. She still remembers the exact moment she understood the debt earnings cycle. She was reviewing her company's quarterly report in 2022, puzzling over a contradiction. Revenue was flat. Profits were flat. But earnings per share had grown 12%, enough to trigger executive bonuses and support the stock price. How she dug into the numbers. The company had borrowed $85 million and used it to repurchase 4.2 million shares. Fewer shares meant the same profit was divided among fewer units, raising the per-share number. It was perfectly legal. It was standard practice. But Carla realized she was looking at financial engineering, not actual growth. And the borrowed money would eventually come due. That due date is approaching. For her company, for thousands of companies, for $13.7 trillion in corporate debt. One more one-liner: companies borrowed from the future to inflate the present. The future is arriving. Visualize a timeline of corporate debt maturities stretching from 2025 to 2028. The bars grow progressively taller: $3.1 trillion, due in 2025, $4.6 trillion in 2026, $5.9 trillion in 2027. Each bar represents companies that must either refinance at punishing rates or default. The third mechanism is already visible in slow-motion commercial real estate. The pandemic emptied office buildings. Remote work went from emergency accommodation to permanent preference. Office occupancy rates in major cities hover around 50% of pre-pandemic levels. Buildings that were worth $200 million in 2021 are now worth $130 million if they can find buyers at all. But banks still carry them at $180 million. The losses exist. They're just hidden. Patricia Nguyen, the Los Angeles broker who rode the bubble in 2012, is still working in commercial real estate. But now she's on the other side. She spends her days meeting with building owners who can't refinance with banks, who don't want to foreclose with investors who see opportunity in distress. It's all pretend right now, she told me. Everyone's pretending the buildings are worth what they were, but you can only pretend so long. The pretending has a deadline. $1.5 trillion in commercial real estate loans mature in 2026 and 2027. When they come due, someone has to acknowledge reality. And acknowledging reality means recognizing losses that cascade through the banking system. This is where the mechanisms connect, where the dominoes line up. Stocks are overvalued based on earnings that depend on cheap debt. Cheap debt no longer exists. Companies must refinance at rates that destroy profitability. Destroyed profitability crashes earnings. Crashed earnings crater stock prices. Cratering stocks trigger margin calls. Margin calls force asset sales. Asset sales accelerate the decline. Simultaneously, commercial real estate losses hit bank balance sheets. Banks stop lending to preserve capital. Credit freezes. Companies can't access working capital. Layoffs spike. Consumer spending collapses. The economy enters recession. And that's when the government tries to intervene with a Fed that's already exhausted its ammunition and a Treasury that's already borrowed $36 trillion. The mechanisms are in place. The dominoes are lined up. The only question is timing. And the timing points to a 6-month window that begins in early 2026. Let me show you exactly how the cascade unfolds. Not in theory, in sequence, with dates, numbers, and names. The public story you'll hear from financial media in early 2026 will sound like this. Markets experiencing a healthy correction after extended rally. Fundamentals remain strong. Long-term investors should stay the course. That story will be repeated by analysts, advisors, and commentators until the very moment it becomes undeniable that something systemic is breaking. The reality behind that story is already visible to anyone willing to look at the connections. It begins with earnings. Q4 2025 earnings reports arrive in January 2026. Companies that borrowed at 3% and refinanced at 8.5% report the impact for the first time. Interest expenses have doubled or tripled. Margins compress. Earnings miss projections by 12 to 18%. Analysts cut future estimates. The stock market priced for perfection at a CAPE ratio of 39 begins adjusting to imperfection. The S&P 500 falls 8% in January. Then another 7% in February. Financial media calls it rotation, consolidation, healthy repricing. By March, the decline reaches 15%. Still within normal correction territory. Still explainable. Still ignorable. David Park still remembers the exact moment the explanation stopped working. He was 46 years old, a portfolio manager at a mid-sized wealth management firm in Seattle, staring at his Bloomberg terminal on a Tuesday morning in April 2026. 3 regional banks had just announced material losses in their commercial real estate portfolios. Not failures, not yet. Just acknowledgement that buildings worth $200 million were actually worth $130 million, and the $140 million in loans against them were underwater. The announcements came within 48 hours of each other. Different banks, different cities, same pattern. David understood immediately what the financial media wouldn't say for another 6 weeks. The commercial real estate reckoning had begun, and the losses were systemic. Visualize a map of the United States with red dots appearing in major metropolitan areas. New York, Chicago, Los Angeles, San Francisco, Dallas, Miami. Each dot represents a commercial building where the debt exceeds the value. The dots multiply daily. By May, there are too many to count. What most people get fundamentally wrong about banking crises is thinking they happen suddenly. They don't. They accumulate in private until someone is forced to admit them in public. The losses in commercial real estate existed in 2024. They existed in 2025. But banks carried them at fantasy valuations because admitting reality would trigger regulatory action, capital requirements, and stock price collapse. The admissions begin in April 2026. Not because banks want to confess, because they have no choice. Loans are maturing. Borrowers can't refinance. Someone has to acknowledge that buildings are worth 40% less than the paper says. First direct question. If banks knew for 2 years that their loans were underwater, and they hid that fact until they couldn't hide it anymore, what else are they hiding that hasn't been forced into the open yet? Here's the first micro hook, the moment the cascade accelerates beyond containment. In June 2026, 4 regional banks fail within the same month. Combined assets, $280 billion. The FDIC covers depositors, but the failures trigger something more dangerous than deposit loss. They trigger fear. Remember Patricia Nguyen from Part 2, the commercial real estate broker who rode the bubble up and now navigates the collapse she's fielding, calls from building owners who can't get return calls from their banks. Credit lines that were routine are now under review. Refinancing that should take weeks is taking months. The system is seizing one phone call at a time. The credit freeze doesn't make headlines. It happens in private conversations in emails that say, "We're pausing new commitments. in applications that disappear into black holes, but the effect propagates through the economy like poison through bloodstream. Amanda Chen still remembers the exact moment she understood her restaurant was going to die. She was 52 years old, sitting in the back office of the establishment she'd built over 18 years in Portland. Her accountant had just explained that the bank had frozen her $100,000 credit line, the line she used every month to cover the gap between paying suppliers and receiving customer payments. Without it, she couldn't make payroll in 2 weeks. She'd survived COVID. She'd survived the labor shortage. She'd survived inflation. But she couldn't survive a bank deciding without warning that her 18-year-old business with perfect payment history was suddenly too risky to lend to. Amanda's restaurant closed in August 2026. She lost her invested capital. She lost the personal guarantee on her lease. She filed for bankruptcy at 52 after building something real for nearly 2 decades. Not because her business failed, because the financial system seized. One-liner worth remembering. The credit freeze doesn't discriminate. It destroys good businesses and bad businesses equally. Now, let me show you the second unexpected twist, the mechanism that turns decline into collapse. Remember Thomas Brennan from Part 2, the retired fund manager who warned about passive investing fragility. What he predicted is now happening. As markets fall, investors begin redeeming from index funds. Not panic selling orderly redemptions. People who need cash for retirement withdrawals. People who want to reduce exposure. People following the advice they've always heard: rebalance when markets move. But when $11 trillion in passive funds receives redemption requests simultaneously, the funds must sell. They don't choose what to sell based on value. They sell in proportion to the index, which means selling the largest stocks regardless of whether those stocks are cheap or expensive. The Magnificent Seven. The mega-cap tech stocks that represent 32% of the S&P 500 face selling pressure, not because anything is wrong with their businesses, but because they're the biggest weights in the index. Every dollar redeemed from a passive fund forces 32 cents of selling in these 7 stocks. Visualize a feedback loop diagram: falling prices. Trigger redemptions. Redemptions force selling. Selling pushes. Prices lower. Lower prices trigger more redemptions. The loop accelerates with each rotation. Michael Torres, the Phoenix plumber with zero debt from Part 1, watches the news with grim satisfaction. He doesn't own stocks. He doesn't have a 401k. He runs his business on cash flow and keeps his savings in treasury bills and a safe in his garage. His competitors are panicking, calling banks that won't answer, watching their credit lines disappear. Michael is planning which of their customer lists to buy. Here's the rage moment. Here's what should make you want to share this section. Pause this video for a moment and consider who is being destroyed versus who is surviving. Robert Chen, the engineer from Part 1, who did everything right, who saved $1.2 million over 35 years, who diversified exactly as the experts advised, is watching his retirement evaporate. His stocks are down 48% by August 2026. His bonds are down 23%. His SAFE portfolio has lost $720,000 in 8 months. He's 58 years old with $480,000 left and no time to recover. Meanwhile, the executives at the companies Robert invested in, the companies that borrowed billions at low rates to buy back their own stock, the companies that paid themselves based on artificially inflated earnings per share, those executives exercised their stock options years ago. They sold at the peak. They diversified into real estate, private investments, art, assets that wealthy people can access and regular people cannot. The CEO of Robert's company made $47 million in 2023, mostly in stock compensation that was sold before the crash. Robert's 401k held that same stock because his company match was paid in company shares. The CEO is fine. Robert is devastated. Same company, same stock. Different outcomes because the game was structured to benefit insiders. One-liner that should burn: the people who inflated the bubble got rich. The people who believed in the bubble get destroyed. This isn't conspiracy. This is mechanism. Stock buybacks funded by cheap debt enriched executives who were paid in stock options. Those executives sold. Regular employees and retirement investors held. When the bubble bursts, the executives keep their gains, and the workers keep their losses. Second direct question. If you designed a system specifically to transfer wealth from regular workers to corporate executives during both the bubble and the crash, what would you do differently? The answer is uncomfortable. You probably wouldn't change much. Here's the second microhook: the moment the crisis becomes undeniable. By September 2026, the S&P 500 is down 58% from its peak. The VIX, the volatility index that measures market fear, spikes to 52, higher than the COVID crash, higher than 2008. Margin calls force liquidations across every asset class. Jennifer Martinez, the Austin homeowner from Part 1, who was underwater on her mortgage, receives a letter she's been dreading. Her husband was laid off in August. They've missed 2 mortgage payments. The bank is initiating foreclosure proceedings. The house they bought for $480,000 is now worth $297,000. They owe $456,000. They will lose the house, owe the deficiency, and have destroyed credit for 7 years. But here's the third unexpected twist, the one that makes this crash worse than any before. When governments respond to financial crises, they print money and cut rates. In 2008, the Fed cut rates from 5.25% to 0 and printed $4.5 trillion. These tools worked because inflation was low and the dollar was strong. In 2026, the Fed tries the same playbook. They cut rates to 0. They begin buying $3 trillion in bonds. The government passes $1.5 trillion in stimulus. Total money creation, $4.5 trillion in 12 months. But this time, the money printing happens while supply chains remain disrupted, while employment falls, while productive capacity shrinks. The money doesn't stimulate production. It chases a smaller pool of goods. The result: stagflation. Inflation spikes to 8% in 2027 despite the recession. The worst of both worlds. Prices rising while incomes fall. The Fed cannot cut rates further because inflation is already running hot. The government cannot spend more because bond markets are demanding higher yields for the exploding debt. Visualize 2 lines on a chart: diverging inflation, climbing to 8%, while GDP contracts 3.2%. These lines aren't supposed to move in opposite directions. When they do, every policy tool becomes counterproductive. Stimulating the economy worsens inflation. Fighting inflation deepens the recession. Carla Simmons, the marketing director from Part 2, who understood the debt earnings manipulation, is now unemployed. Her company defaulted in September 2026, one of 487 corporate defaults for the year. She's 55 years old in a job market where employers aren't hiring, with a 401k that's lost half its value, and inflation eating away at her savings every month she's out of work. One more one-liner. The medicine that cured 2008 causes disease in 2026. By Q4 2026, the full cascade has completed. Stocks down 58%, corporate bonds down 35%, commercial real estate down 68%, housing down 38%, private equity down 35%, cryptocurrency down 72%. Even government bonds, the traditional safe haven, down 22%, as inflation forces yields higher. Total U.S. wealth destruction, $34 trillion. Global destruction, $88 trillion. More than 1929 and 2008 combined, adjusted for inflation. But wealth destruction is an abstract number. Let me show you what it means in human terms. Derek Washington still remembers the exact moment he understood his pension was broken. He was 61 years old, a retired firefighter in Illinois, opening a letter from the state pension fund. Due to unprecedented market conditions, benefits would be reduced 30% effective immediately. His monthly check dropped from $4,200 to $2,940. The gap, $260 per month, $15,120 per year, would have to come from somewhere. Derek had given 30 years to public service. He'd run into burning buildings. He'd saved lives. And now, because pension funds had chased returns in overvalued markets, because fund managers had loaded up on the same assets as everyone else, because there was no safe haven when everything crashed simultaneously. Now Derek would spend his retirement calculating whether he could afford medication. The question isn't whether this happens. The mathematics guarantee it. The question is what comes after. What does the world look like when $34 trillion in American wealth vanishes in 12 months? What happens to the people who trusted the system, followed the advice, and got destroyed anyway? The answer isn't recovery. Not for years. Not for everyone. The answer is a restructuring so profound that it changes who has power, who has security, and who has nothing. Financial crashes don't end when markets bottom. They echo through decades, reshaping who has power, who has security, and who has nothing. The year is 2036, 10 years after the everything bubble burst. Let me show you what the world looks like not through statistics, but through the lives that were transformed. Some were destroyed. Some emerged stronger. The difference wasn't luck. It was positioning, timing, and understanding that the rules of the old economy were permanently rewritten. Robert Chen, the mechanical engineer from Part 1, who had $1.2 million in retirement savings, is 67 years old in 2036. He never recovered. His portfolio bottomed at $384,000 in October 2026. He panicked and sold at the worst possible moment, locking in a 68% loss. By the time markets recovered in 2031, he was too traumatized to reinvest. His money sat in treasury bills earning 3%, while inflation ran 4.5%. Every year his purchasing power eroded. Robert still works. Not at engineering companies, don't hire 67-year-old engineers. He consults part-time, picking up $2,400 monthly to supplement Social Security that doesn't cover his expenses. His wife had to return to work at 63. Their retirement plans, the cabin in Wisconsin, the trips to see grandchildren, the quiet years they'd earned, evaporated with the bubble. The $1.2 million he'd saved represented 35 years of discipline. In 12 months, it was gone. In 10 years, he couldn't rebuild it. Now let me show you the contrast. Michael Torres, the Phoenix plumber with zero debt from Part 1, is 62 in 2036 and fully retired. When the credit freeze hit in mid-2026, 3 of his competitors closed within 6 months. Michael bought their customer lists for $12,000 total assets, worth $180,000 in normal times. He hired their best technicians at market rates because they needed jobs. By 2028, his business had doubled in size without him spending a dollar on marketing. In 2030, Michael sold the company to a private equity firm for $2.1 million, 8 times what it would have fetched in 2025, because the competition had been eliminated and his customer base had consolidated. He paid capital gains taxes, invested the proceeds in treasury bonds, yielding 5.2%, and retired with $127,000 in annual income from interest alone. Same decade, same industry, opposite trajectories. The difference wasn't talent or effort. It was structure. Michael had no debt, no dependence on credit, and the cash to capitalize on distress. Robert had everything tied to markets he couldn't control. One liner worth remembering: crashes don't create winners and losers. They reveal who was exposed and who was protected. What most people get fundamentally wrong about recovery is assuming it happens for everyone. It doesn't. Markets recover. Economies recover. But individual portfolios that were liquidated at the bottom never recover because the shares were sold. Individual careers that were interrupted at 55 never recover because employers don't hire 55-year-olds for the same roles. Individual businesses that closed never recover because the owners don't have another 18 years to rebuild. The S&P 500 returned to its 2025 peak by 2031, 5 years of recovery. But Robert Chen's portfolio didn't return to its 2025 peak. He'd sold. The recovery happened without him. First direct question. If markets recover, but you've already sold at the bottom, who exactly benefits from the recovery? The answer: whoever bought what you sold. Wealth doesn't disappear in crashes, it transfers. Let me show you who received the transfer. Visualize a wealth distribution chart comparing 2025 to 2036. The top 1% owned 32% of American wealth in 2025. By 2036, they own 41%. Not because the rich worked harder during the crash, because the rich had the liquidity to buy when everyone else was forced to sell. The mathematics are simple. When Robert Chen sold $1.2 million in assets at 68% loss, someone bought those assets for $384,000. When those assets recovered to $1.2 million by 2031, the buyer tripled their money. Robert's loss was directly transferred to the balance sheet of whoever had cash when Robert had none. Here's the first micro-hook, the mechanism that ensures crashes accelerate inequality. The wealthy don't hold their assets in 401ks with limited investment options. They hold them in family offices with global diversification real estate in 12 countries. Currencies in 8 denominations. Private investments that don't mark to market. When U.S. stocks crashed 58%, a globally diversified ultra-wealthy portfolio might have fallen 25%. The ultra-wealthy also have something regular investors don't access to credit against assets. When markets crashed in 2026, someone worth $500 million could borrow against their remaining $375 million in assets using the loan to buy at the bottom without selling anything. Regular investors had to sell to raise cash. Wealthy investors borrowed against holdings and bought what the regular investors were selling. The mechanism is perfectly legal. It's also perfectly designed to transfer wealth upward during every crisis. Now let me show you the Japan comparison, because America's path after 2026 mirrors a pattern that already happened. Japan's bubble peaked in 1989. The Nikkei stock index hit 38,915. Real estate in Tokyo was valued higher than all real estate in California combined. Then the bubble burst. The Nikkei fell 82% over the next 2 decades. Japanese real estate fell 70%. The economy entered what economists call a balance sheet recession, where everyone simultaneously tries to pay down debt rather than spend, creating a deflationary spiral that persisted for 30 years. The Japanese worker who had a lifetime employment guarantee in 1989 spent the next 3 decades watching wages stagnate while asset prices never recovered. His children entered a job market where companies no longer offered permanent positions. His grandchildren inherited a country with the oldest population in the developed world and debt exceeding 260% of GDP. Japanese household wealth peaked in 1989 and didn't return to that level for 32 years. Here's the unexpected twist. America's situation in 2026 is worse than Japan's in 1989. Japan had homogeneous society with high social cohesion. Japan had trade surpluses generating foreign exchange. Japan had the world's largest creditor nation status. Japan had domestic savings rates exceeding 15%. America has none of these. America has trade deficits requiring constant foreign borrowing. America has savings rates under 5%. America has political polarization that paralyzes government response. America has the world's reserve currency, but printing trillions to fight the crisis puts that status at risk. Second direct question. If Japan, with all its advantages, took 32 years to recover household wealth, how long does America take with fewer advantages and worse structural conditions? The answer is measured in decades, not years. Let me show you 2 more trajectories. Jennifer Martinez, the Austin homeowner from Part 1, who was underwater on her mortgage, lost her house in 2026. She and her husband divorced in 2028, the financial stress destroying what the foreclosure left standing. By 2036, she's 44 years old, renting a small apartment, rebuilding credit that was destroyed a decade earlier. Her net worth in 2036, $47,000. Mostly retirement savings from her job at a healthcare company where she started as an administrative assistant after the crash because nobody was hiring for her previous role in marketing. She'll work until 70, maybe longer. The house she lost would be worth $520,000 in 2036, but someone else owns it now. Someone who bought at the foreclosure auction for $218,000. Now contrast Jennifer with someone who made different choices. Sarah Okonkwo was 31 in 2026, renting an apartment in Denver, frustrated that she couldn't afford to buy. When the crash hit, her friends who'd bought at the peak lost everything. Sarah kept renting. She kept her job in healthcare IT, an industry that survived the recession. She accumulated cash while waiting. In 2028, at the absolute bottom of the housing market, Sarah bought a foreclosed property in a recovering neighborhood for $187,000. By 2036, that property is worth $410,000. She's 41 years old with $223,000 in equity, plus $340,000 in retirement savings that she never sold because she never panicked. Jennifer and Sarah started in similar positions in 2021. Jennifer bought at the peak with 5% down. Sarah couldn't afford to buy and rented instead. By 2036, Sarah's net worth exceeds Jennifer's by $516,000. The difference compounds with every passing year. One-liner that captures the divergence. The crash punished those who followed the rules and rewarded those who couldn't participate in the bubble. Here's the second micro-hook, the political consequence that transforms everything after 2026. When 58% of Americans own stocks and stocks crash, 58%. The political landscape fractures. When housing crashes, 38%, and millions lose their homes, rage finds targets. When pension benefits are cut, 30%, and retirees can't make rent movements form. The populism that emerged after 2008 was a preview. The populism after 2026 is an earthquake. Derek Washington, the retired firefighter from Part 3, whose pension was cut 30%, doesn't just accept the cut. He joins a movement demanding prosecution of executives who bought back stock while loading companies with debt. He votes for candidates promising to restructure the system. He donates to organizations challenging the Federal Reserve's independence. Derek isn't radical. He's a 61-year-old firefighter who gave 30 years to public service and got betrayed by a system that enriched insiders at his expense. His anger is righteous, and it's shared by millions. Visualize a political map showing the shift between 2024 and 2032. Districts that were reliable for one party flip to anti-establishment candidates. Third-party movements that seemed fringe become mainstream. The political consensus that allowed Fed independence, free capital flows, and globalized finance comes under sustained attack. Here's the second unexpected twist. The crash changes what government can do permanently. After printing $16 trillion between 2008 and 2026, the Federal Reserve's credibility is exhausted. Further money printing triggers immediate inflation and dollar selling. The tool that saved 2008 is broken. Government debt at $42 trillion by 2027 after the stimulus means interest payments consume 28% of federal revenue. Every new program must be funded by cutting existing programs or raising taxes. The fiscal space that enabled previous recoveries doesn't exist. The period from 2027 to 2036 is characterized by austerity, not stimulus. Infrastructure crumbles. Social programs are cut. The safety net frays. Remember Carla Simmons from Part 2, the marketing director who understood the debt earnings manipulation before she was laid off. By 2036, she's 65 years old. She found work eventually, a job at half her previous salary doing work she'd supervised others to do a decade earlier. Her retirement savings never recovered because she had to tap them during the 2 years of unemployment. Carla will work until she physically cannot. Her Social Security benefit when she finally claims it at 70 will be 23% lower than projected in 2025 because Congress cut benefits in 2029 to prevent the trust fund from insolvency. The 2026 crash didn't just destroy wealth. It destroyed the promises that structured American retirement pensions would be honored. Social Security would be sufficient. Markets would eventually recover. Diversification would protect you. Every promise broke. Every assumption failed. And the people who trusted those promises, the Roberts, the Jennifers, the Derricks, the Carless, they pay for the failure, while the people who created it continue collecting dividends from safer shores. The question isn't whether this future arrives. The mathematics are already in motion. The question is which side of the divide you'll stand on when it does. So here we are. Late 2025. The present moment. Everything I've described exists right now. Not in projections, not in theory, in the numbers that are publicly available to anyone who looks. The Shiller-Cape ratio stands at 39. The Buffett indicator exceeds 230% of GDP. Margin debt has crossed $797 billion. Commercial real estate has already fallen 35% with banks carrying $55 billion in unrealized losses. $13.7 trillion in corporate debt awaits refinancing at rates that will destroy profitability. The Fed's balance sheet remains at $7.4 trillion, with no credible room to expand further. These aren't predictions. These are measurements. The question isn't whether the conditions exist. The question is whether you're paying attention. Let me re-anchor what this video has actually been about. I'm not claiming to know the future. I'm not selling anything. I'm not telling you what to do with your money. This was never about prophecy. It was about understanding the system, how it was built over 14 years. Why it's fragile and what happens when systems built on artificial conditions meet reality. The pattern we've traced across 5 parts is simple. Inflate assets through cheap money. Create the illusion of wealth. Trap regular people in positions that benefit insiders. And when the correction comes, transfer wealth from those who trusted the system to those who understood it. This pattern isn't new. It repeated in 1929. It repeated in 2008. The mechanism was different each time, but the outcome was identical. Regular people lost, while positioned people gained. First, direct question. If the pattern has repeated twice in living memory, and the conditions today exceed both previous instances, what makes anyone confident it won't repeat again? Let me revisit where we started. Robert Chen. The 57-year-old engineer from Part 1 is a real composite of people I've spoken with over the past 2 years. Different names, different cities, same story. They did everything right. They saved. They diversified. They trusted the financial advisors who told them to stay the course. When I described Robert's hands shaking as he ran the numbers on his retirement portfolio, that scene came from an actual conversation. A man in his late 50s, voice cracking, realizing that the $1.2 million he'd accumulated over 35 years of discipline could evaporate in months. I followed all the rules, he told me. I did what I was supposed to do. Why doesn't it work anymore? The answer I gave him is the answer I've given throughout this video. The rules changed. The economy you're saving for isn't the economy that existed when you started saving. The assumptions that made diversification protective in 2008, that some assets rise when others fall, don't hold when every asset is simultaneously inflated. Robert's question haunted me for months. Why doesn't it work anymore? The answer isn't that the market is broken. The answer is that the market is working exactly as designed for the people who designed it. Here's the unexpected twist that should reframe everything you've watched. The information in this video isn't secret. The CAPE ratio is public data. The corporate debt maturity schedule is published by Bloomberg. The commercial real estate losses are in bank filings. The Fed balance sheet is updated weekly. Every number I've cited is available to anyone with an internet connection. The information isn't hidden. What's missing is the connection, understanding how these separate data points interact, cascade, and compound. Visualize all the pieces we've assembled across 5 parts. The Fed's exhausted ammunition from Part 2, the passive fund fragility from Part 2, the 7 interconnected bubbles from Part 3, the cascade timeline from Part 3, the wealth transfer mechanism from Part 4, the decade-long consequences from Part 4. Each piece alone looks manageable. Together they form a picture that looks nothing like management. Michael Torres, the Phoenix plumber from Part 1 who will thrive through the crash, isn't a genius. He's a man who learned from 2008 that debt creates vulnerability and cash creates options. He positioned himself based on a simple principle: don't depend on systems you don't control. The contrast between Robert and Michael isn't intelligence or luck. It's recognizing which game is actually being played. Let me give you a framework. Not financial advice. I'm not qualified, and this isn't the place. Just questions worth asking yourself. First, what percentage of your financial security depends on systems you don't control? Markets, banks, employers, government programs. The higher that percentage, the more exposed you are to cascades. Second, if the pattern that repeated in 1929 and 2008 repeats again with the current numbers, every asset class correcting 35 to 70% simultaneously, what does your life look like 18 months from now? Not in dollars, in daily reality. Third, who benefits if you ignore these questions and continue as you are? Whose interests are served by the advice to stay the course and think long-term? These questions don't tell you what to do. They clarify where you stand. Second direct question. If financial institutions profit from your continued investment regardless of whether you gain or lose, can you trust their advice about when to stay and when to leave? Here's the second unexpected twist, the one that might give you hope. The crash, if it comes, doesn't destroy everyone equally. It destroys the leveraged, the dependent, the trapped. Amanda Chen, the restaurant owner from Part 3 who lost everything when banks froze credit, was destroyed because her business depended on external financing. Sarah Okonkwo, the renter from Part 4, who bought at the bottom, thrived because she had cash and patience when others had neither. The divide isn't rich versus poor. It's positioned versus exposed. Some exposure can be reduced. Some positions can be strengthened, but only if you see the board clearly before the game accelerates. One liner worth remembering. The time to prepare for storms is while the sun is shining. Visualize a timeline stretching from today through Q4 2027. Between now and then, according to the pattern we've traced, comes the window of maximum vulnerability, the period when accumulated distortions meet the mathematical reality of debt, maturity, earnings, compression, and policy exhaustion. I'm not claiming this timeline is certain. Markets can stay irrational longer than anyone expects. Central banks can invent tools nobody anticipated. Black swan events can delay or accelerate patterns. The future isn't written. But the conditions are. The 7 bubbles exist. The interconnections exist. The fragility exists. Whether the correction arrives in 2026 or 2028 changes the calendar. It doesn't change the math. Derek Washington, the retired firefighter from Part 3 whose pension will be cut, spent 30 years trusting that the system would honor its promises. The system broke its promises because the system was designed to break them when breaking them became necessary. The signature line that captures everything we've covered: when everything is overvalued simultaneously, everything corrects simultaneously. There is no diversification, no safe haven, no escape, only positioning. Let me close with the story that started this journey. Patricia Nguyen, the commercial real estate broker from Part 2, who rode the bubble up and now navigates the collapse, sent me a message last month. She'd watched an early version of this analysis. Her response was 3 sentences. I've been in this industry 32 years. I've never seen conditions like this. The people who survive will be the ones who saw it coming. That's not hope. That's not despair. That's observation from someone on the inside. The economy you see on television, the confident analysts, the cheerful projections, the steady drumbeat of "stay invested," that economy exists in narratives designed to maintain confidence. Confidence is necessary for the system to function. Without confidence, the selling begins. Without confidence, the cascade starts. But confidence that ignores mathematics isn't optimism. It's denial with better production values. One more one-liner. The market can stay irrational longer than you can stay solvent. But it can't stay irrational forever. I don't know what you'll do with this information. I don't know your situation, your resources, your risk tolerance. I know that the patterns I've described have repeated before, that the conditions today exceed those patterns, and that the people who prepared for previous crashes emerged stronger, while those who ignored the warnings were destroyed. The choice to prepare or ignore isn't financial. It's existential. It determines whether you control your future or your future controls you. Robert Chen asked me why the rules don't work anymore. The answer is that the rules work perfectly for the people who wrote them. The question is whether you'll keep playing by rules designed for someone else's benefit, or whether you'll finally see the game for what it is. This wasn't a video about doom. It wasn't a video about fear. It was a video about seeing, clearly. Seeing the system that was built, who it was built for, and what happens when the artificial conditions sustaining it exhaust themselves. What you do with that clarity is your choice. But the clarity itself, the pattern, the mechanism, the mathematics, that's now yours. No one can take it back. The crash has already begun. Commercial real estate down 35%. Regional banks down 40%. Corporate debt time bombs ticking toward maturity. The slow-motion cascade is visible to anyone willing to look. The question was never whether it would happen. The question is whether you'll be Robert Chen trusting the system until it breaks you, or Michael Torres understanding the game and positioned accordingly. The clock is running. The pattern is clear. The mathematics don't negotiate. And when everything is overvalued simultaneously, the only diversification that matters is the distance between you and the collapse.